Committing fraud is a serious crime, most especially if another party is proven to suffer damages or loss. The Philippine Standards on Auditing number 240 defines fraud as an intentional act by one or more individuals among management, those charged with governance, employees, or third parties involving the use of deception to obtain an unjust or illegal advantage. According to common law, a fraudulent act must meet the following five conditions. First, there must be a false statement or a non-disclosure. Second, a fact must be a substantial factor in inducing someone to act. Third, there must be the intent to deceive or the knowledge that one's statement is false. Fourth, the misrepresentation must have been a substantial factor on which the injured party relied upon. Finally, the deception must have caused injury or loss to the victim of the fraud. Fraud can result in harm to others, such as financial losses of an organization and its investors. It is important that the accounting information system of a company is designed properly to prevent and detect misstatements resulting from fraud. In a business organization, who is responsible for the prevention and detection of fraud? The answer is both those charged with governance of the entity and management. Those charged with governance may include management personnel. For example, executive members of a governance board of a private or public sector entity, or an owner-manager in case of a sole proprietor business, whose responsibility is for overseeing the strategic direction of the entity and obligations related to the accountability of the entity, including overseeing the financial reporting process. Management is the person or persons with executive responsibility for the conduct of the entity's operations. For some entities, in some jurisdictions, management includes some or all of those charged with governance. For example, executive members of a governance board or an owner-manager in case of a sole proprietor business. There are two types of fraud in a business organization: employee fraud and management fraud. Employee fraud, or fraud by non-management employees, is generally designed to directly convert cash or other assets to the employee's personal benefit. Typically, the employee circumvents the company's internal control system for personal gain. On the other hand, management fraud is committed by management employees. This is more insidious than employee fraud because it often escapes detection until the organization has suffered irreparable damage or loss. Management fraud typically contains three special characteristics. First, the fraud is perpetrated at levels of management above the one to which internal control structures generally relates. Second, the fraud frequently involves using the financial statements to create an illusion that an entity is healthier and more prosperous than in fact it is. And third, if the fraud involves a misappropriation of assets, it frequently is shrouded in a maze of complex business transactions, often involving related third parties. According to a study, people engage in fraudulent activity as a result of an interaction of forces both within an individual's personality and the external environment. These forces are classified into three major categories: situational pressures, opportunities, and personal characteristics. Situational pressures are situations or events that force people to commit fraud. For example, unrealistic sales targets set by top management, forcing salesmen to make fictitious sales to meet quotas due to fear of losing their job. Opportunities are situations or events that allow people to take advantage of the situation. For example, a manager using his position of authority to steal money since he or she can prepare, review, approve, and pay expenses. Personal characteristics refer to having a low level of honesty and integrity. For example, people with low moral character rationalizes his or her contradictory behavior, or a wheeler dealer, which means someone who has a desire for power, influence, or social status. People who engage in fraudulent activity make plans or arrangements to commit such acts. These are called fraud schemes. Fraud schemes can be classified in a number of different ways. Three broad categories of fraud schemes are defined based on the Association of Certified Fraud Examiners, or ACFE's study. First, fraudulent statements or fraudulent financial reporting. Second, corruption. And third, asset misappropriation. Fraudulent statements are associated with management fraud. Fraudulent financial reporting involves intentional misstatements, including omissions of amounts or omissions of disclosures in the financial statements to deceive financial statement users. Corruption involves an executive, manager, or employee of the organization in collusion with an outsider. The ACFE defines corruption as the wrongful use of influence to procure a benefit for the actor or another person, contrary to their duty or the rights of others. The ACFE study identifies four principal types of corruption: bribery, illegal gratuities, conflicts of interest, and economic extortion. Misappropriation of assets involves the theft of an entity's assets and is often perpetrated by employees in relatively small and immaterial amounts. However, it can also involve management, who are usually more able to disguise or conceal misappropriations in ways that are difficult to detect. The next video is about computer fraud. Click the video on the left screen to know more about it.